Hey dreamers, when you're a beginner, a common investing question is, when is the best time to start investing in stocks? But can I tell you a secret? The idea of when to jump in and out of the market or particular stocks never goes away. Did you hear what I just said? It's always a question in an investor's mind. It's a question when you get that bonus at the end of the year and you're sitting on some additional cash. It's a question you ask yourself when the market is high, and perhaps you wonder if you should hold off on investing more. And what about that coming recession? I see people asking questions like, should I just wait for another crash before I put money into the stock market? Or, hey, I'm already 40. Why should I start now? Essentially, we're talking about market timing. And if I knew the answer to all of this, I'd be the richest person on earth. But for what it's worth, today I'll talk about my point of view on market timing and how I think about when to jump in. So let's start with my most incredible story of market timing. The one where in 2019, I was getting really scared of the US leadership and the moves the US was making, namely taking all the pandemic watch sites and employees down to almost nothing across the world, deregulation in several areas, and withdrawing from the world's stage. To me, all of those moves spelled disaster of some kind. So I went to 100% cash, 100%. And so in that fateful time period of March 2020, when the market crashed all the way down to below 18,600 points, in my brokerage account, as I went from March 23rd, 2020 to March 24th, 2020, I lost nothing. And as you already know, I was in shock, just like everyone else. My first reaction was to make sure that my family was safe, all of my loved ones were safe, but everybody was panicking. Everything was shutting down. People were dying. So honestly, I just sat frozen for a week or so. But after that, I started focusing in on my investments. Oh my gosh, could this be a once-in-a-lifetime opportunity? So the drops that you see here were actually me quickly shifting money into a second brokerage account, which you now know is my TD Ameritrade account, but also sifting money off the top throughout the next 6 months. So what does all of that have to do with timing the market? In my mind, nothing. I exited out of fear, and I just so happened to have caught a wave coming off of a big global catastrophe. I'm sure I won't catch the next one. It was simply a bit of luck. And it's impossible to make this a way to win on a consistent basis. But maybe that story makes you think, okay, I'm definitely waiting for the next recession. Now, I'm not an economist, but here's what I see. I see the personal saving rates in the US the highest they have been in over 60 years in 2020 and 2021. So cash is at an all-time high. And there's a ton of pent-up demand. Everyone wants to get back to doing the things that they used to do, like going on vacation, going to movies, restaurants, hotels, and simply returning to the normal routine. The one thing they don't want to do is go back to traveling for work. But the problem is, the pandemic continues to plague us even now. And over the last month or so, China's lockdown of their factories is a ripple that's gonna hit us again soon. In addition to the lockdown of their ports, with 1 in 5 container ships being stuck outside these ports. So the reality is that the supply chain is gonna continue to have issues, with another big wave of issues coming our way. Now, this pandemic has been really hard on so many people and families. And I have had close friends lose loved ones to COVID. But from an economic perspective, losing 1 million US people means that there's a lot less people simply in the workforce anymore. If you add that to the retirement at record numbers across so many different industries, you end up with the lowest unemployment rates we have seen in decades. There are hiring crunches everywhere, and I don't think that's going to switch back to high unemployment anytime soon. So I'm thinking a mild recession or slowdown period perhaps might happen in 2023 or 2024 when all the supply chain catches up and the demand starts to flatten out. So what does all of that have to do with timing the market? In my mind, almost nothing. It just means that barring another major catastrophe, I believe we could actually be in for a steady year or maybe two. So how would that make you feel if you sat on the sidelines for another 2 years? It's so hard to predict the market future. Let's see how it looks in terms of returns. I always like to go back to this chart from Bank of America, where they looked at the impact of missing the market's best and worst days each decade. Looking at the data going back to 1930, they found that if an investor missed the S&P 500's 10 best days each decade, the total return would stand at 28%. If, on the other hand, the investor held steady through the ups and downs, the return would have been 17,715%. Of course, the data also shows the astronomical returns for any investor who correctly called the 10 worst days of each decade, to the tune of 3,793,787%. Additionally, excluding the 10 worst and best days would have registered a gain of 27,213%. So if you were to look at the Dow in the last 5 days, you can see that we are down almost 5%. And if you look 1 month, we're still down. 6 months, we are still down from 6 months ago. And a year ago, we are still below that. But if you go back 5 years, we are up 60% from 5 years ago. And compare that to 40 years ago, it's significant. So the reality is, if you are a long-term investor, the likelihood of you netting out ahead goes up substantially. So, with all of that said, here's my point of view for real on how and when to start. Look for what's on sale first. If everything's on sale like I had in 2020, great. Buy everything you would like to hold. You know what I like based on my portfolio, which you can see in one of my recent portfolio update videos. In general, I like great brands with strong management, lots of free cash flow, and a long history of paying and growing dividends. This is when I'd go all in with lump sums. If the market is high, the sales are less easy to find, like now. But there still may be a few companies out there, or at least you're paying fair market price for the stock. And then long-term hold and reinvest the dividends for compound growth. Here, I might dollar cost average into the market as you see fit. That means investing a little bit at a time and watching for down days to pick up more shares and take advantage of small market dips. The reality is, if you have the time to spend researching the economy, the companies, the competition, and really calendar out all the potential announcements for the micro, macro, and company level detail, you might be able to eke out a little bit of an advantage. But overall, if you zoom out, you will realize that one of the biggest factors of investing success is time. And so once you figure that out, you realize that the best time to start is now, or as soon as you are ready. And with that, I'll remind you to do your research so that you can and will be ready to start as soon as possible. I wish I had figured out this strategy decades earlier. Well, I hope you found this useful. Thanks for spending time with me today. And the disclaimer, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.